Stockwatch is brought to you by Merchant West. Where others stop, we push further. Because we believe business as usual doesn't lead anywhere new. Go beyond with Merchant West. Finance, invest, insure.
Welcome to Stockwatch with me, Simon Brown, and joining me to unpack your stock-related questions today, Bright Khumalo from Vestact, Drikus Combrinck from Capicraft. Be sure to send questions through email stockwatch@bdtv.co.za, SMS 41392, or on Twitter at BusinessDayTV, #Stockwatch. Gents, appreciate the time. Drikus, let's start with you. US bank earnings, US earnings season has kicked off. As always, the banks, some good numbers there. I mean, Citi on every level. We did have some caution from was it JP Morgan around debt provisions. They worried about, I think it was an extra $800 billion US. How much is this telling us about the US economy? Because Jerome Powell spoke and he said jobs are struggling.
Yeah, I think we shouldn't look too much into the headline numbers at the moment. Look at the comments, especially around, bad debt provisions. That's starting to tick up. You see stuff like credit card delinquencies, auto loans starting to tick up in the US the last few months, last few quarters. Still not at alarming levels, but they are starting to tick up. And then, on some of these banks' balance sheets, they lend on money to some private equity houses, and those private equity houses, or private credit houses rather, lend on to some issuers. And, the private credit segment in the US has become quite what we call covenant light. And, it's a mark-to-market business. We're not sure what's out there. We saw in the last 2 weeks, the big defaults in what was the company, the auto loan company, or the auto company's name, Auto Parts. Can't remember the name now, but a few banks got caught with indirect exposure on their balance sheets, and there's more of that out there. So I do think that bad debts will be a bigger story going forward for the banks, and I'm just avoiding the sector for now. It looks cheap optically, but I think there's a lot of skeletons hiding in the closet. Nothing GFC like, but at this stage we do not really know, what the indirect exposures to the private credit industry is, firstly, and secondly, I get the feeling the US consumer is, especially the lower part of the US consumer, let's say the bottom 80%, is under pressure.
Brett, does that, we've got FOMC in 2 weeks' time. We don't have data because the US government is on holiday, shut, whatever the case may be. But does that mean we get a rate cut in 2 weeks?
Look, I don't know where we stand at this point. I mean, I think Drikus has alluded to the fact that, the jobs numbers is not going exactly where it's supposed to go. But I mean, the central banker, Jerome Powell, has sort of tried his best to make sure that, Senate on the one side is happy and obviously still keeping a watchful eye on the economy, the jobs numbers and other data points that sort of help, with deciding on, where to take the interest rates. So it's most likely, going to stay where it is now, with obviously there's still, a rates cut, a 25 basis cut pending for the year, according to, betting markets like, poly markets. So let's see what he does. I think, is this the second last meeting of the year? Yeah, if I'm correct. So so there's going to be, it's going to be spicy to say the least.
Probably, yeah. There's this one, and then there'll be the one, I think it's first week of December, maybe second week of December, which is pretty much the last chance. Brad, let's stay with you. CMH, small little motor vehicle company, results out last night. Good numbers, 15% proposing to buy back 15% of shares. I had a question coming through, which was, should I sell my shares? And my answer is, I don't know if you had a look at the numbers, but I wouldn't sell my shares just because some company decides that they want to buy them back. You hang on if you like. Your thoughts on CMH and the buyback? Is it one you follow? It is a micro cap.
It's more, in one of the stock picks, events last year, we did, pick CMH because, they looked extremely cheap. They paid a massive dividend. And then they rallied from there. So unfortunately, I'm not sure if you're a buyer, if you're trying to buy now, there'll be any, sort of catalyst, because we didn't expect a catalyst from management, to do something there. And obviously, there is that pending offer, like you said. And I didn't actually check the numbers, but I mean, you're holding this one for the dividend and the catalyst in the background, so you wouldn't be someone who's buying. But obviously, if you already own these, you're asking yourself, well, do I still sit down, and collect the dividend, or is it time to maybe cash in some of my gains here? And obviously, if you have a capital loss from elsewhere, it'll be a good time to start, taking those gains and maybe allocating elsewhere. That's something I'd be thinking about.
Drikus, for you, I mean, this is a microcap, under 3 billion, PE of around 8, usually a really good dividend payer, but this time suspending the dividend for the buyback. Drikus, for you, CMH?
Yeah, well, I like the results. I think they've done well. I think a fair chunk of their sales at the moment are Chinese vehicles. Yeah. Those are obviously much cheaper than the rest of the stuff out there. Sure, quality is still to be proven, but it does look decent. And sales of these cars are flying through the roof. CMH are positioned for that. I think the second-hand market, if this continues, is going to take a beating. So, if you really got some guts, you might short be by cars and long, something like CMH or Motors. I'm not there yet, but I do think this, will puts pressure on the second-hand car market. And I do think CMH is cheap. I think it's a brilliant management team, one of the best management teams maybe on the JSE, and I don't give comments like that lightly. And I think, again, good capital allocation, and I think they're really backing themselves here, buying 15% of the market cap basically back, or 15% of the outstanding shares. Just one thing that back of my mind is that SAS motor industry, the manufacturing of motor industry might be in the process of being destroyed. And what is the use of having import tariffs on German motors, Japanese motors, etc. Any imports, we might as well throw that out the window, and that's not impossible a year or two down the line to say, listen, we haven't got a motor industry anymore. One, that's of note. Throw out import tariffs, import all those vehicles, then we get a massive drop in in vehicles. Sales go through the roof. These companies that sell the stuff does well. Those with large second-hand fleets and those with large fleet businesses will get hammered. Yeah. Okay, just something in the back of my mind, yeah.
Yeah, that's actually a good point. I hadn't thought of it. And the CMH numbers does talk. Almost half of sales were either Chinese or Indian. The Indian mostly being Mahindra, of course. Drikus, let's stay with you. This question came through weeks ago, but it was particularly, please ask Drikus, about the land companies he mentions from time to time that are earning royalties. It was a stock pick last time you were on, you and I together. Talk us through some of the logic. These are companies that essentially own large tracts of land and then take royalties off, I don't know, a miner or a data center or whatever.
Sure. So you've got your royalty companies. So there are those with, that own outright royalties. Franco-Nevada is, the big one. Or Texas Pacific Land Company would be one that owns large tracts of land, between Texas and the Pacific. And that dates back to more than 100 years, when they were still part of the railroad company. That I think it was unbundled about a century ago. And with the shell boom, that one really took off. And Texas Pacific Land has just outperformed basically 99% of everything on the S&P 500. So you don't need to own the Max 7 to outperform the market. And then the one we like at the moment is Landbridge. They do not own large, or they do not own continuous pieces of land all the way to the Pacific like a railroad company would do. They own chunks of it together, and I think they're better positioned for data centers going forward if the AI boom continues. if they land one or two big data center contracts in with the West Texas in the Permian Basin, where there's cheap electricity, where there's cheap land, etc., I think that one really starts to fly. A bit of blue sky in that one. And if you just want to own land for the sake of owning it and earning a little bit of a dividend, a bit of a bond proxy, if you will, with the inflation protection, there's two REITs to look at, and that is called Farmland Partners, and the other one is Gladstone Land. Gladstone has come down a lot. I think it looks juicy at these levels.
Yeah, and they are giant. I was looking at, I think it was Mark Zuckerberg tweeted or whatever, posted, Instagrammed, I don't know, a picture of their new data center. It's the size of Manhattan. These things aren't football fields in size. They are cities of size. Bright, a question coming through. I'm looking for some China exposure. Has your panel got any ideas, or should I just buy Naspers?
I don't know. I feel like every 2 to 3 years, the China question comes around. Is China too cheap? Should I be buying now? Or should I just, don't become too smart and just stick to an ETF or just hold my Naspers? I would say buy your Naspers, probably keep, adding to them regularly. For us South Africans, I think that's the easiest exposure. And there's still a lot of, catalysts in the background. I mean, these guys are still investing in early startup businesses. They're doing exceptionally well. The current CEO, comes from, is an entrepreneur. There's an eye for these things, and he was brought into the stable, of Naspers through, a sort of a buy-in to his business. So he's very much aware, and he knows what's happening in those areas. And there's a lot of growth potential, not just in China when it comes to technology, but in India, where they seem to be on the forefront in terms of investments there. So I'm pretty excited about Naspers. I mean, I guess if you, try to find a video of me talking about Naspers 10 years ago, I probably said the same thing. So, and I wasn't wrong then. There's been a lot of, value unlock, in e-commerce, things like food delivery that we only see now. So obviously, you must be a long-term shareholder if you're investing in these newer startup type businesses. So, yeah, in terms of an ETF, I don't know, man. I'm a stocks guy. I tried the China ETF thing; didn't work for me. So if you dig deep, look at the top 10 businesses in China, you might find something that you are well versed in. I'd rather do that than trying to game the system by buying a very broad ETF, which doesn't make sense to me.
Yeah, I take your point in it. I mean, I think there's a Satrix and a Signia ETF, and they've both had a slightly tough time of it, and but certainly Naspers done a whole lot better with some of the individual stocks. Drikus, for you, China, is it a sector? It's not a sector, a geography, a market that you like, and how would you go about getting some exposure?
Well, firstly, we can't ignore the Chinese economy. It's enormous. Its influence on capital markets and the global economy is huge. Do you have to own Chinese shares? I'm not so sure. You've got obviously the Chinese. It's become Chinese policy basically to support the market at the moment. So I think you've got a bit of a margin of safety. Yes. I think they're spending a lot of money. I think that the fiscal deficit this next year will be about 10% of GDP, which is huge. They're really turning open the taps. So big fiscal spending. They're pivoting that towards the middle class, towards consumer spending. After they've had basically post-COVID, they've run an export model again and dumping all kinds of cheap goods all over the planet. They're trying to stimulate the local consumer again, which is really, in a state of a depression-like consumer sentiment. So they're really trying to, there's a lot of positives to sum up. But the problem is, if the events this last year, and especially the last 2 weeks, does not frighten you owning Chinese shares, then you're not paying attention. There is a decoupling underway. It's not about the Trump administration. It's not about his persona or what MAGA wants. There's a decoupling coming. Yeah. It's a bipartisan issue in Washington. They see each other as not only competitors on the global landscape, but as essentially enemies, if you ask me. I think there's a decoupling coming. How fast it happens, I don't know. But you might wake up one morning with a Russia-like scenario where your Chinese ADRs are with zero. That is there's a non-zero, probability of that happening. So I see it as a trade, and the Chinese positions that we do have in our funds are those that we are prepared to lose outright if it should happen. So if it goes to zero, the portfolio will be fine. But there is a lot of upside left in Chinese equities in a fairy tale scenario.
Yeah, and I take a point around the decoupling, and also it's not Trump. Trump might have started it, but I mean Biden didn't pull back on any of the tariffs, and if anything, he actually escalated some of them. Drikus, let's stay with you. Question coming through. I've got a portfolio. It's got some Capitec, Naspers, Shoprite, Kira, Goldfields, Master Drilling. I'm looking at two sleeping giants. Their words, not mine. Sasol and or Aspen. Would you be adding Sasol or Aspen to a portfolio at this point?
Yeah, I'm not too clued up on Aspen. I see they've got a drug. Is it them that's got a big drug that they will be able in 2026? Yeah, so I do think that helps. It's not expensive, but I'm not into pharmaceuticals at the moment. I think, as I've said before on the show, pharmaceuticals in the West and maybe even here will come under the political spotlight. It has come already in the West under the political spotlight and will continue to do so. So I'm out of the pharmaceutical sector for the next season or so. But Sasol, I think there's a lot of value in Sasol. Obviously, refining margins are under pressure within the chemical sector. Chemical margins are paper thin. But once again, you do not need to play China by buying Chinese shares. One of the things that the Chinese want to do is they want to kill some of the excess capacity that they have in certain industries. One of them is what you call the teapot refiners, and with that there's a couple of chemical players as well within China, and they want those guys out of the market, or they want them smaller part of the market, and that will increase refinery and chemical margins in the rest of the planet. So that will be a big one for Sasol if that were to happen over the, say, next 6 months to 18 months. And there's a lot of low-hanging fruit that Sasol management can pick, to turn around this company. It's not expensive, and you might see 200 Rand again on this share.
Bright, can I interest you in a Sasol or an Aspen?
Sasol, no comment. Aspen, I probably should be saying the same, but I'm going to say it differently, rather. As someone that invested in Aspen in 2010 around $80 and it's trading at $100 today, I've lost an enormous amount of money on this one. I don't know why we still hold it, quite frankly. So I don't know, man. It feels like there's always news, good news, and then there's a bit of a squabble, in the growth phase with a bit of the partners in their businesses, whether it's China, whether it's Europe, whether, it's Americans, their partner. It just doesn't, I don't know, man. It's not doing what it's supposed to do. And as Drikus has pointed out, I'm just going to reiterate what he said. Running a pharma business is extremely hard, especially if you're not manufacturing any of your own patented products. Even if you do, the research and development is very expensive. There's a lot of competition when you go off patent. There's already vouchers circling to take what you've, had groundbreaking discoveries on, and it's a loser's game. I'm sorry. There's far better opportunities out there for your money, because on a rand for rand, a dollar for dollar basis, you could take the same amount, put in LVMH, which is looking very cheap right now, or take the same amount, buy something else, something in AI that could be something very different tomorrow. So I don't know. The opportunity cost for me to invest in Aspen currently in a world full of opportunities is extremely high.
Yeah,
I wouldn't put my money in it. Yeah.
And I take your point. It has been a fair litany of management disappointments, let's say, over the last decade and a half. So, Brad, then what about ASML? Results out last night. It's currently in pre-market, up some 4%. Some good-looking numbers coming out of AML. Some of them as expected, some better than expected. And, of course, they're the kind of part of the picks and shovels part of the AI race, per chance.
Yeah, so they obviously sell those fabrication machines that everyone needs in order to make their chips, right? So picks and shovels, it's a good pick. You're not going to lose a lot of money with this one if um, AI doesn't turn out to be what it wants to be. But I mean, with current spending, especially in the West, where a lot of companies are bringing fabrication and all sorts of different parts of AI investing onshore, this is definitely one of the winners, because instead of sending those machines down to China and Taiwan, which are the two biggest markets geographically currently, you want to start seeing Europe and the US, North America in general, Canada and the US come to market as they buy those machines. But that's going to take a very long time, because as I look at it in these third quarter numbers, Taiwan is still 30% of their revenues, China is still 42%, USA is 6%. That's where we expect most of the growth to come from. South Korea is about 18%. We'll probably stay around those numbers. So North America needs to, put those dollars to good use and buy some ASML machines. So that's the current, proposal, I guess, investment thesis, to say it's going to drive the ASML share price. But of course, if the dollars that are invested in North America have a lower ROI than Taiwan and China, I see that trade turning around in China and Taiwan, continuing to buy more of their machines, which is not a bad thing.
Yeah, I take a point on that. Drikus, ASML for you?
Yeah, I'm a bit of a skeptic on the AI cycle. Not that I do not think that AI has enormous potential. I use its functions, almost daily now. But is it monetizable over the short to medium term? Will we have a kind of a capex implosion a year or two, from now? I don't know. I just do know that the semiconductor industry, as well as the adjacent industries that will include ASML, these guys are extremely volatile, and we've forgotten that.
Yeah, absolutely. And I mean, to be clear, ASML is part of that volatility, and notwithstanding all the excitement in the sector, it is a stock that is somewhat off its all-time highs. Well, they're getting closer to it on today's move on the back of results. Let's go to some stock picks. Drikus Calgro M3, stock I hold, came out with results on Monday. The results perhaps a little disappointing, but the commentary is certainly good, and a nice-looking business. And heck, we need houses in this country.
Yeah, and they're slightly pivoting the business. Obviously, we know the Memorial Parks has increased, and that's only about 8% of the group sales at the moment, but that will continue to increase, and that's a nice annuity income coming in for them, or definitely a diversify, if not annuity income, sorry. But good cash liquidity on the balance sheet, about 150 million rand sitting there. It's a better cushion than we had before. This is a company that had to go through a rights issue about 5 years ago, just before COVID, I think. And, the company's earnings, I think, is a bit understated at the moment. I think, a lot of the projects that they're doing at the moment, they've expensed. It's on the balance sheet, and they will only start selling them in the next quarter or two. Or the next year at least, and then that will translate into earnings. Interest rates are dropping. It makes the obviously property more affordable going forward in SA. I think they've pivoted into some nice areas of the property market. They're moving to the Western Cape, obviously, where there's big demand. And, it's extremely cheap. I think it's sitting at close to 15 Rand NAV.
Yeah.
Even if you say, listen, they're going to struggle to earn their weighted average cost of capital, put a discount of 40% on that, you still get you about, 8-9 Rand a share that it's worth. So I think there's some what we might call deep value here.
Yeah, absolutely. And I like the discounting of the NAV, because that 15 Rand NAV to me has never been a number I've held too much credence with. Bright, you're going with LVMH, numbers out. Everyone was asking me on the questions, why is Richemont flying? Well, because LVMH knocked it out the park and is up 14%, and you still like it at current levels.
So it was extremely cheap in the past 2 years. And, if you've been following LVMH for a bit of time, you'll know that when leather goods doesn't do well, it trades like a commodity. So when leather goods, sort of loses sales, doesn't do well, as soon as you see that leather goods market reverses, you see LVMH starting to pick up. And this was the first set of numbers that's showing that the leather goods is not really growing. It's just organic growth for the overall group is 1%, so it's turning positive. But the most important thing is that the deceleration in leather goods has sort of flattened. So you're seeing Dior and Louis Vuitton sort of, flat in terms of, losing market share or, not seeing as much shoppers, coming to the market. So the expectation is we're going into holidays. You're gonna start seeing that leather goods number starting to pick up, and hopefully we're at the beginning of a bull cycle for the leather goods. So that's the reason why, the number one, you're getting in on the cheap. Number two, cyclically, you're seeing a reversal in leather goods. And if, their competitors are anything to look at in terms of leather goods, like you're saying, Richemont, and with their Chloe brand, and obviously Hermes, most importantly, also leather goods looking strong there. So, I have it in good authority that we're going to see, the cycle here, see an uptick. So it's a good time to be buying LVMH.
Yeah, absolutely. And I mean, the luxury sector, LVMH is having a knockout day, but the whole luxury sector globally is responding in kind to those LVMH numbers. That's all for Stockwatch today. Thanks to our guest, Bright Khumalo from Vestact, going with LVMH. Drikus Combrinck from Capicraft, Calgro M3 was his pick. Up next, the close.
Stockwatch is brought to you by Merchant West. Where others stop, we push further. Because we believe business as usual doesn't lead anywhere new. Go beyond with Merchant West. Finance, invest, insure.